$63.4 billion. That's the number on the paperwork filed in a Manhattan courtroom on December 2, 2001. It made Enron Corporation the largest bankruptcy in American history, a record that would stand for exactly 10 months. 16 years earlier, this had been a pipeline company from Houston with a market cap nobody outside the energy business could name. By the summer of 2000, its stock had touched $90 a share. Its trading floor moved more money in a day than most countries' GDP, and Fortune magazine had just called it America's most innovative company for the 6th year running. Something happened between the pipeline and the paperwork. To understand what, you have to start at the end and walk backward, because the ending is the only part everyone already knows the shape of. 3 weeks before the filing, Enron was still trying to survive. Dynegy, a smaller rival, had agreed to buy the company in a rescue deal worth roughly $9 billion. On November 28, 2001, Dynegy walked away. Credit agencies downgraded Enron to junk within hours. Without investment-grade credit, Enron's energy trading business couldn't function. Counterparties simply stopped answering the phone. The company that had built its identity on being the smartest operator in the room couldn't get anyone to trade with it. 4 days later, it filed for bankruptcy. Go back further to October 16, 2001. Enron announces a third-quarter loss of $638 million, along with a $1.2 billion reduction in shareholder equity. The company blames it on unwinding a set of partnerships with an odd, almost cute internal nickname, the Raptors. Wall Street doesn't know exactly what a Raptor is yet, but it knows the number is bad, and worse, that the company can't clearly explain where the loss came from. 3 days later, the SEC opens a formal inquiry. This is the moment the private problem becomes a public one, and once it's public, it's unrecoverable. Everything after October 16th is Enron trying to explain a hole that keeps getting deeper the closer anyone looks at it. Go back 2 months earlier. On August 22, 2001, a vice president named Sherron Watkins sits down privately with Chairman Kenneth Lay. She spent weeks going through the company's books and doesn't like what she's found. She tells him, in plain terms, that Enron's accounting could unravel and take the company down with it. Lay has his lawyers look into it. The lawyers, working from a narrow mandate and limited access, report back that there isn't an obvious legal problem. Lay does not restate earnings, does not go to the board with Watkins's full concerns, and does not tell investors anything. He goes on doing what he's done for 16 years, reassuring people that Enron is fine. 8 days before that meeting, on August 14th, Jeffrey Skilling resigns as CEO after only 6 months in the job, citing personal reasons. He'd been the architect of Enron's entire trading culture, the man who pushed the company from moving physical gas through pipes to trading contracts about gas, and eventually contracts about almost anything. Employees are stunned. Skilling had never talked about leaving. He sells a large block of Enron stock on his way out the door. The timing will follow him for the rest of his life. Back up 6 more months to March 2001. A Fortune reporter named Bethany McLean publishes a piece asking a simple, uncomfortable question. How exactly does Enron make its money? She can't find a clear answer in the public filings, and neither, when she calls around, can most of the analysts covering the stock. It's the first crack in the story Enron has been telling Wall Street for years, that this is a company too complex and too clever for outsiders to fully model, and that the complexity itself is proof of sophistication rather than a warning sign. Now go back to where the actual mechanism starts, 2 years before anyone outside the company is asking questions. In 1999, Chief Financial Officer Andrew Fastow creates 2 partnerships, LJM1 and LJM2. He pitches them to Enron's board as vehicles that will buy underperforming assets off Enron's books and hedge risk on paper investments that have soured. What he doesn't say quite as loudly is that he intends to run these partnerships personally, while still serving as Enron's CFO, and that Enron itself will be the entity's main trading partner. Enron's board approves it anyway, waiving its own conflict of interest rules to let it happen. Picture a man who owes his own bank a large debt, so he opens a second bank across the street, uses it to buy that debt off the first bank's books, and reports to shareholders that the first bank is now debt-free. Nobody at either institution has actually gotten any richer. The money hasn't moved. Only the appearance has. And that mechanism has an earlier ancestor. In 1997, Fastow builds a partnership called Chewco to buy out a pension fund's stake in a joint venture. Under accounting rules at the time, an entity like this can stay off Enron's balance sheet only if outside investors put up at least 3% of its capital, independent of Enron itself. Chewco doesn't meet that bar. The 3%, when investigators later dig into it, turns out to have effectively come from Enron in disguise. Almost nobody outside a handful of finance executives notices at the time. It's a technical footnote in a filing nobody reads closely. It is also the first domino. Every partnership that follows, LJM1, LJM2, the Raptors, is a larger, more confident version of the same trick. Move the debt somewhere it doesn't have to be counted, and let the stock price do the rest. None of this required Enron to be fake. That's the detail most retellings get wrong. Enron ran real pipelines, moved real gas, employed over 20,000 people, and built one of the first functioning online trading markets for energy in the world. The fraud wasn't inventing a business. It was refusing to let a real business's real losses show up on paper, one small off-balance sheet decision at a time, until the gap between what Enron reported and what Enron actually owed had grown too large to hide and too large to fix. $63.4 billion in assets listed on a single bankruptcy filing. Behind that number sits a much smaller one, 3%. The share of outside capital a 1997 partnership needed and didn't quite have to make its books legal. Nobody in that room thought they were signing off on the largest corporate collapse in American history. They thought they were solving a bad quarter.